Gold isn't certainly isn't flashy in this environment. I think it's down a couple percentage points on the year, but the concept behind that call was that it was going to be the safest asset when compared to Bitcoin and to the stock market. And I still think that. I still think there's a lot of volatility remaining in this year. I still think there's more downside on the S&P and on Bitcoin. So I'm sticking with gold. And I actually think gold will start to actually lead going into the second half or into the end of the year, where we actually should see it head back towards that 2000 high. So I think the main places to be are in things like gold. Silver's a little bit more volatile because of the industrial side, so it gets pushed around due to economic out views, I should say. But the
Hmm.
bottom line is, I think also cash is a great place to be, because as we see stocks decline, I mean, Apple's come off, Microsoft's collapsing. As you see those type of declines, if you're in cash, you're going to get great opportunities to kind of get into these plays at much lower levels. So I think cash and gold are great places to be. A little platinum, maybe a little bit of palladium, those type of things, but be diversified. I think that's the key, is be diversified so you're safe. I think that right now the markets are reacting to this very hawkish Fed statement from kind of Jackson Hole. And I think that is sending the dollar skyrocketing, which the market does not like, right? Then you throw into the mix, you have Russia still kind of on the view of investors. Now Taiwan and China's kind of out there. And I think that creates this kind of nervousness where people are hiding in the dollar. You
Hmm.
add that to the hawkish Fed, and the dollar has been so strong. However, towards the end of this year, I'm looking for the economy, unfortunately, to slip into a recession and the Fed to get much more dovish. Maybe not cutting rates, but at least being done with raising rates, even if inflation's still above that 2% mandate. So I think that's your kicker, where you also get the gold to start to outperform in that environment, but the stock market could really start to take a hit. The concept behind my downside of 20 to 30% in the stock market for end of year 2023 is that you have to look at it and say, okay, how does the Fed get us out of the next recession? in
Hmm.
in past recessions for like the last 20 years, they've lowered rates, they've printed money, they've done all that stuff. If inflation is still above 2%, they can't do that. And I think that is going to be very bad for the overall stock market when investors realize that they can't print us out of the next recession. And I do worry, and last thing I'll say is I do worry we get into this kind of like stagflation-ish environment where the economy is just kind of in a minor recession, but we
Right.
just don't get out of it. We just are stuck there with inflation, let's say at 4%. And I think that's the worst case scenario for stocks. So the key is to understand is that when the dollar gets stronger, it's good for you as Americans, for instance, because we can purchase more goods
Hmm.
from overseas. So if you want to go on that trip to Europe, if you want to go on that trip to Asia, your dollar gets you more. The problem is that for risk assets, a stronger dollar is not good. And for stocks as well, because there's so many stocks like an IBM or an Apple that have so many sales. A lot of their revenue comes from overseas. And so let's say they sell an iPhone, Apple sells an iPhone in Japan, and then they get yen for that in Japan. And then at some point, they have to convert that back to US dollars. Well, if the dollar has strengthened 10% against the yen, they're losing 10% of that sale right on that conversion. And that's
Mm.
why the stronger dollar for a lot of these companies, which are now almost every company is multinational. So that's why it's such a negative for the overall stock market. I'm at the point where I do believe that the highs from 2021, the all-time highs on the stock market, we probably won't see those for 5 or 10 years again. So I
Wow.
mean, it's not just we're down in a bear market for 2 years. I think you can look at the charts like the Hang Seng in China, the Brazilian stock market, the EWZ, and you can see that you're trading in those markets where we were still trading in 2010. And
Right.
I do think that the Federal Reserve, by printing so much, pulled the gain so far and so fast to the forefront that we now have to go into this long period of digestion of those runs where we're not going to see new all-time highs. So it's going to be more of a trader's market, but longer term investors are going to definitely kind of be left kind of saying, where's my gains? But I think this is the kicker, is that you're not in that scenario. You have a much different economic situation. You have a much different inflationary situation. It's a much more globalized economy. And I think honestly that he wants to talk this tough game to kind of scare the markets and get inflation down. In all fairness, Powell didn't like that the stock market had rallied so far back
Right.
because that's inflationary. So he was very harsh on his comments and kind of talked it down like that. But I think ultimately you're going to see this situation where we see the stock market say, you know what, I don't really believe it. And in fact, one of the things, and this is a great point, on Friday, we saw these comments, 8 minutes of comments from Jerome Powell, and the stock market collapsed. And we're
Right.
seeing downside yesterday and today and so forth. The kicker is, if he was that hawkish, why didn't the bond market, why didn't the 10-year yield spike? Because the 10-year yield did not move at all after those comments. And
Right.
what that tells me is the bond market, which is known as it's the biggest market in the world, it's said to be the smartest money, they're saying, we don't believe him. Because
Wow.
if they believed him, interest rates should have shot through the roof, and they didn't. And you could even look at the dollar, and the dollar again is staying strong, but it's not breaking out. So I think there's a lot of people calling BS on Jerome Powell here. At least the smarter money is. The stock market just hasn't figured it out yet. So I think it's going to be 50 basis points in September. Jobs data this Friday. I wouldn't be surprised if it starts to show a little weakness, which actually could be a positive for the kind of the lower rate kind of cycle or thought process. And then I think maybe you'll get another 25 basis points later in the year. And I think the Fed is done at that point. I think they're very close. They're just trying to talk their tough game because otherwise the stock market will run away and kind of push inflation up. But I don't think that they see the underlying linings of what the economy is doing. And it's not a good sign out there, even though we're getting these quick little tidbits of strong signals. It's all lagging indicators. The jobs market is a lagging indicator. It takes like 3 to 6 months to cycle through, and we are not even close to that yet. So you still can get some decently strong jobs numbers, but
Right.
my guess is it's going to start to weaken, and it's going to weaken fast when it does. So right now, I'm definitely playing a little bit more heavily in the gold market
Okay.
because of that risk of the industrial side. So I really love silver longer term, 6 months, 12 months.
You better love it.
Yeah, I figured as much, right? But for me, it's the gold side, which is kind of that safety play, that conservative, more cautious play. And so it's really a matter of, where do I want to hide in this kind of volatile, no winning scenario type situation where inflation's high, but the Fed's tightening, but with the economy's weakening, all these negatives are out there. And for me, that's where gold is. Now, I do have some silver, but gold definitely is the one that I'm more heavily invested in. Now, if we do see at some point the economy bottom out, and let's say the Fed starts to think about lowering rates and printing money, that's going to be stimulative to the economy. Then it's all about silver hardcore at that point. I think once the market realizes that the Fed has no exit strategy for inflation staying above 2%, but the economy now slipping into recession, they can't print money because inflation's still too high, but they can't
Hmm.
tighten because we're seeing an economy in recession. That's going to be where the precious metals absolutely start to take off.